Your income's going to come from somewhere. Do you want to come from these sources because that's just what you decided? Or do you want to tax efficiently figure out where is the right source for that year? Welcome to the Retire on Time Q&A podcast. My name is Michael Decker. I'm here with David Franson. This show is all about answering your questions, but not the oversimplified advice you've heard hundreds of times. We want to get into the nitty gritty. That said, remember, it's just a show. This is not financial advice. Keep doing some research. Text your questions to 913-363-1234, and we will feature them on the show. David, what do we got today?
Hey, Mike, what's one tax minimization strategy that often gets overlooked in retirement?
I think the structuring of income year by year is one of the most missed opportunities. And here's why. So a lot of people think tax planning is IRA to Roth conversions. And though that is an important and effective strategy, it's not the only one.
All right.
Okay. A simpler one in my mind is to say, okay, I'm going to retire next year. Okay. I've got IRA assets, got it. Got some Roth, got it. And I've got some brokerage funds, got it. Okay. I'm gonna retire at 62 years old. Okay. So I've got a couple of years before I'm going to hit Medicare. No problem.
All right.
Well, what if I had enough in the brokerage funds that I could fund 2 years of my retirement? And what if in the brokerage funds, they were highly appreciated assets? You might say, well, gosh, the basis is so low, right? The basis being like, let's say you bought a stock at $5 a share, now it's worth $500 a share. I'm being
Okay.
facetious, but
Yeah.
it's you bought it and it just grew like crazy. Now, if you sell it, you're paying taxes, right? Well,
Mm-hmm.
this is the part that's often missed is capital gains taxes start at the end of ordinary income tax.
Ah.
So when you're not working, let's say you're married filing jointly, you've got like 90 some, like almost $100,000 of gains that you can realize. What if you needed, I don't know, $120,000, okay? And in the brokerage account, you could sell, you know, 90,000 of gains and the rest of it is basis. You just sold a little bit. You're paying 0% in taxes.
Mm.
So that not only helps maintain the principal, so you don't need to spend money and pay taxes. That lowers your portfolio overall. You're keeping more money in your accounts, and if you have more money in your accounts, they're going to grow better. What's 7% of $1 million versus 7% of $800,000?
Mm.
The $1 million is going to have more dollars in it because the compounding interest. It's an incredible thing. The other part is your healthcare.
Mm-hmm.
And if you know how to structure this right, and you know your income is basically going to be zero taxes, you may qualify for the Affordable Care Act benefits that they're what do you call
The
The
subsidies?
subsidies. Thank you.
Yeah.
That people thought went away. They didn't go away. It's just the subsidies on steroids went
Yeah,
away.
like the premium subsidies
Yeah.
are gone, but the regular subsidies are still there.
You can still qualify for those. And if
Yeah.
you know how to report and say, hey, these are my taxes this year, like, look, I think I qualify for these subsidies, you can manipulate your taxes so that you're efficient on the income, you leave more in your accounts to grow, and you qualify for more healthcare just by doing that one thing. Now, think of your Apple stock that you've been holding since, I don't know, the 90s or
Yeah.
2000s, whatever they incorporated.
Yeah.
Think of your Microsoft stock that you bought years ago. Think of, I'm going back to my Seattle days, right? Microsoft, Amazon, Boeing, highly
Yep.
appreciated assets that were hard to get out of.
Right.
This is how you get out of it. Think of your NVIDIA stock that you bought during the pandemic because you spent too much time on Reddit and you heard about this company and AI was a thing and you got in early. We had clients that got in at like $3, $4, $5 a share or something crazy like that.
Yeah.
This year, they're not paying any taxes federally. Their state had capital gains tax. They couldn't get out of that. But it'd be like $2,000, $3,000
Yeah.
for taxes for the entire year. That's not a bad deal.
Yeah.
It's really not a bad deal. So structuring your income by years, not just by, I'm going to turn on the income and whatever happens, happens, and that pays for the taxes. That's so oversimplified, generic, waste money. So that's I think one of the most easy to implement tax minimization strategies that are often overlooked because people associate that, well, here's my income, here's my social security, here's my pension, or here's my annuity for lifetime income or whatever it is.
Yeah.
That's my ordinary income. I'm at like 80,000 already right there, maybe $100,000. So they're stuck paying 15% anytime they sell their long held positions.
Oh.
If they just pushed out Social Security a little bit, if they just pushed out turning on that annuity, they just pushed out some of these IRA distributions or IRA to Roth conversions just a
Mhm.
year,
Mhm.
how much more would they have to spend? And there's a ripple effect. I mean,
Mm.
when I do a plan and I see these operations or these opportunities, I go, okay, well, there's $30,000 there that we can get you right away.
Mm.
How would you like to spend $30,000 less on taxes? It took
Huh.
me 30 seconds to see it.
Right.
That's that's how that strategy works. Not everyone's gonna be able to execute on it. Some people have to put everything into retirement accounts and so on, that's fine. Some people are gonna have a larger concern with required minimum distributions. They just save too much,
Oh.
and they're gonna be forced into higher tax brackets later. So everyone's gonna be different, but that's an easy one. I'll give you a second one. It's just reading your tax form. Your 1040, that's the tax summary, basically, you get back after you file your taxes,
Mhm.
and just understand kind of what is in there. Why are those numbers showing up there? And what could you do in your portfolio to shift that around?
Mm.
Just an idea. That's all I'm saying.
So your guy and your for your gal, whoever, the person in the example, they had some brokerage funds that could sort of bridge the gap to when they were gonna start turning on Social Security and things. So why shouldn't that person take from their IRA instead of touching the brokerage funds and paying capital gains?
Yeah, if you took out 50, 60,000 of IRA assets, let's say you did an IRA to Roth conversion or you just took that money out,
Yeah.
then you've got 50, 60,000 less of capital gains
Uh,
in the 0% bracket.
uh,
So if you take out 60,000 of ordinary income is what this is, then let's say it's just for easy math, 100,000 is the basis. You could only realize 40,000 of basis before you start paying 15% on the gains that you're or 40,000, I'm sorry, of gains that you're going to pay, and then you start paying 15% on the gains.
mm,
Why would you pay 15% on taxes that you don't have to? You're going to pay ordinary income tax on these other ones.
uh-huh.
Not You don't have to on the
Mm,
gains. You just need to kind of understand the differences.
mhm,
So that's the main thought with this. Um, and you can get more technical by saying, all right, we're going to take 20 or 30,000 of the IRA, which is fine, but that cancels out with the standard deduction. And then you go with the capital gains route. Like there,
okay.
so I'm not trying to be an absolutist here. What I'm saying is just understanding each year, how are you going to take your income? Do
Yeah.
you really care where your income comes from?
Just give it to me. I need it.
It just, yeah,
I got pickleball to play.
yeah.
Right?
You're a tennis player.
Oh, I do. I do like
You can't
tennis.
fake. You can't fake it. But the idea is your income's going to come from somewhere. Do you want to come from these sources because that's just what you decided, or do
Mhm,
you want to tax efficiently figure out where is the right source for that year?
mhm.
That's the ongoing conversation that needs to be had, and you really need to have it, in my opinion, every year at the end of the year. So when someone's talking about, "Oh, well, this is kind of what happened, and we'll do some IRA to Roth conversions and see what happens next year," the question should be, "How am I gonna take income next year? What's the taxes what are the taxes gonna look like,
Yeah.
and why is that the case?" Some foresight might be help
Yeah.
I don't know, might be
Yeah.
helpful.
Right.
But I think that's the one to look at is don't just line up income streams, line up year by year the income that you wanna take and how you wanna take it.
Mm.
I think that's about all the time we got for today's show and this question. Make sure to text your questions to 913-363-1234. And don't forget to go to retireontime.com. We've got tax calculators, we've got planning calculators, we've got so many calculators and planning tools that you can use, all free, publicly available. You don't even need to enter your name and email address to access them. I hate that. Maybe you do too. Up to you. Retireontime.com. You can even join me for a workshop where I build a retirement plan live. If you want to work with a professional, you can also click talk to a planner, schedule a free 30-minute call, and we'll learn more about you and what you got going on and decide on the best way to proceed in preparing for you to be able to retire on time. Thanks for joining the show. We'll see you in the next episode.